Paul, welcome to Constituting America's Constitutional Chats. We're going to ask that you share your thoughts on the case that we're discussing today, Moore versus the United States, and maybe a little just on the 16th Amendment in general, and then we'll go to questions.
Well, thank you, Kathy. It's great to be with you. I had the privilege of talking to your group a few years ago, and I'm delighted to have the chance to be back. I'm also, excited to talk about the Moore case because or what you're calling the Trump tax cuts case, because I think this is one of the sort of sleeper cases of the Supreme Court term. I think for a lot of people, they hear about taxes or tax cases and their eyes glaze over a little bit. And I certainly sympathize in the sense that, if you hear about cases involving the First Amendment or the Second Amendment, they just seem a little more accessible, a little more interesting. And one of the things I hope to impress upon folks today is that, the taxing power in the Constitution is itself something that is very important to the whole structure of our government. And that this case in particular is potentially a very interesting case because of its implications, not just for this particular sort of tax cut or tax provision, but for the possibility of a wealth tax, which is something that's in the news quite a bit. In fact, I read something in the Wall Street Journal this morning about an international proposal for a bunch of different countries to agree to have some kind of joint wealth tax. So the possibility that the government could not just tax you when you purchase something in the store, a so-called sales tax, not just tax how much money you make at the end of the year, the so-called income tax, but could also just tax you for essentially the money you have in the bank or the value of your home or other ways of estimating your overall wealth, I think is something that would really be a pretty big change from the way that we've done things to date. And so the constitutionality of proposals like that, I think, make this Moore case, dare I say it, more interesting than maybe you would think at first blush. So just let me tell you a little bit about the case, and then maybe in the process tell you a little bit more about the taxing power under the Constitution. So in some ways, it's a little bit of a misnomer to talk about this case as one of the Trump tax cuts, because the particular provision that the Supreme Court is focused on, although it was part of the Trump tax cuts in 2017, actually is one of the provisions that was designed to raise some money to pay for some of the other tax cuts. And so the particular provision here focused on something that really affected very few taxpayers, which is the possibility that you could have a substantial ownership interest in a corporation located outside the United States, where 50% or more of the total shares in the company were owned by United States citizens. And the particular concern that Congress was addressing by adding this particular provision is the possibility that taxpayers could sort of avoid or at least defer their taxes for a substantial amount of time if they had an investment in a foreign corporation and that foreign corporation just accumulated wealth and never redistributed any of that wealth to the shareholders in America. So to understand what Congress was addressing, you have to just think about the concept of realization. And the way our tax code generally works is, in broad terms, when we have income taxes, we don't tax income unless it's been realized, which is unless it sort of hits your account in some meaningful way. And so if you invest money in a stock, let's say you buy stock in Meta, and the Meta stock doubles in value. Just because the stock doubles in value doesn't mean you're going to have to pay any taxes on that. And generally with things like stocks or your house, the government doesn't try to tax you until you actually sell something and realize income. And that's the point at which they decide that they're going to tax you. And that does create the possibility that people can put off their taxes, even though they're accumulating lots of additional wealth by just, not having a so-called realization event. And in a lot of ways, we tolerate that. So we're perfectly happy. The federal government's perfectly happy for people to buy stocks, to have the stocks go up in value, and nobody's taxed until you ultimately sell them, or you're taxed when they pay dividends and things like that, because that's when the money hits your account. But there are certain circumstances where I think the tax authorities are very concerned that you're just going to delay and delay and delay and never pay any taxes, even though you're becoming much more wealthy and you're earning what seems like interest. And in the context of foreign corporations, that was a particular concern because it seems like you're keeping the money outside of the United States. So to help pay for the Trump tax cuts, Congress put in this provision that basically said, if you have money in a foreign corporation, the foreign corporation has made a lot of income, and you haven't distributed any of that, hasn't it been distributed to U.S. shareholders, we're going to essentially treat a certain percentage of their income as if it has been distributed to shareholders in America. So the individual taxpayers here, the Moores in this case, were hit with a $15,000 tax bill, even though they didn't have an extra $15,000 hit their bank account based on their investment in this foreign company. And this goes all the way to the Supreme Court. And the question for the Supreme Court is whether or not this is consistent with the 16th Amendment. So to understand the 16th Amendment, you really have to go back to the original unamended Constitution and the particular provisions that put a limit on the taxing authority of the federal government. And if you think about the structure of the Constitution, it's structured in a way that actually makes a lot of sense. Most of the powers that are affirmatively granted to Congress are in Article 1, Section 8. And most of the limits on Congress's power in the unamended Constitution are in Article 1, Section 9. And one of the provisions in Article 1, Section 9, and I will read it for you, is that no capitation, which is an odd word, but that basically means a tax that is a tax on a single person, no capitation or other direct tax shall be laid in unless in proportion to the census or enumeration herein before directed to be taken. And what the framers were trying to do with that is really address a concern that certain taxes would fall disproportionately on certain states. And so when they were creating the original Constitution and the various 13 original states were deciding whether they would join the Constitution, there were concerns by some large states that the small states would gang up in the new Congress and impose taxes that fell disproportionately on the large states. There were also some concerns in some small states that the opposite would happen. And so the idea on this prohibition on direct taxes without enumeration is that Congress couldn't impose so-called direct taxes without allocating them fairly among the states based on population. So that provision, may or may not seem like it's important. It actually is pretty important because not only does it prevent the federal government from imposing taxes disproportionately on big states or small states, but as a practical matter, it makes it very hard for the federal government to impose really substantial taxes because most of the permissible indirect taxes are things that have built-in limitations. So the way the federal government raised most of its money for the first 100 years were things like duties on imported goods and the rest. And there's only so much money you can raise from those kind of duties and imposts. So as the republic moves on and there are more and more demands on the federal government, Congress decides to impose an income tax. And when that income tax goes to the Supreme Court says no, unconstitutional because a tax on income is a direct tax and it is not apportioned among the states, so it's unconstitutional. And as part of what you can somewhat loosely think of as the progressive era amendments, which include the 16th Amendment, the 17th Amendment, the 18th Amendment, the 19th Amendment, as the first of those amendments, Congress responds and the people respond to this act of the Supreme Court holding the income tax unconstitutional. and they specifically authorize a tax on income. And I'll just, so we're all, I believe that text is important, so I'll read you the text. It's relatively short. The entirety of the 16th Amendment says the Congress shall have the power to lay and collect taxes on incomes from whatever source derived without apportionment among the several states and without regard to any census or enumeration. So that really tees up the question in the Moore case. And the question in the Moore case is this a permissible tax on income, or is this a direct tax that's unenumerated and problematic? And the principal argument the taxpayers were making is that in order to have a tax on income, you have to have a realization event. You have to actually have that money hit your account. And so they said, because the $15,000 never hit our account, or the income that was earned by the company abroad never hit our account, you can't tax us in this way. It violates the 16th Amendment. So I'll say two last things before turning it over. One is that I think for those of us that watched the argument, it seemed like the court was looking for a way to decide this case relatively narrowly. And that is what I think they're likely to do. And the second thing I'll say is the reason they were looking for a relatively narrow way to decide this case is, I think for a lot of people, this case was interesting less because of this particularly esoteric tax that only affects, a couple of hundred people, but they were watching it because of what I alluded to earlier, which is what about a wealth tax? Can you just tax like a wealthy person and say we're going to tax 1% of your wealth? Or is that a impermissible direct tax that isn't a tax on income, so doesn't come within the terms of the 16th Amendment? So I think as people were listening to this case, they were looking for clues as to what the court would think about a wealth tax. And I think if the court decides it very narrowly, that may still be a very open question.
Well, thank you. That was a great overview and really interesting history of the 16th Amendment. So thank you so much for that. We're going to go ahead and turn it over to Tova, who I'm sure has got some great questions lined up.
Yes, hi. Thank you so much. This is really, really fascinating. And it's always very interesting to learn about these Supreme Court cases where history is being written as we speak. I can't tell. My computer might be slow, so let me know if I'm freezing up at any point.
You
Good
are
so
freezing
far?
up a little bit, Toba. You might want to turn your camera off,
Okay,
and we'll see if that's
I'll do that.
Okay.
Y'all have seen my face enough. Okay, so first, I wanted to ask if you could just give a general overview. You touched on this a bit in your opening remarks, but could you explain a bit about how the US tax system has evolved since the founding of our nation, especially as the federal government has gotten a lot bigger? Where have like the sources of taxation changed?
Yeah, no, I'd be happy to. And I did allude to this, but I think it's really important to kind of understand that, if you think about the founding of the Republic, the states, sent their delegates to Philadelphia. They were coming up with this new federal government. And the states were still pretty jealous of their own authority to tax. And of course, this is the same sort of group of people that had the Boston Tea Party over a relatively small tax on tea. So taxing questions are very front of mind and are very closely intertwined in the framing generation's mind with the proper role of government and what's kind of an unfair tax. And so it's probably not surprising that in our original Constitution there was not any kind of super broad power to lay taxes. And the principal limitation was this limitation on the unenumerated direct taxes. As I said, that was in part because of concerns about federalism, but definitely also trying to put some limits on just how much revenue that the federal government could raise. And so for, really like the first 100 years, you mostly had taxes being raised through duties and imports. And the sort of nice thing about sort of an indirect tax, I suppose, and maybe the way that, you can distinguish it from a direct tax is an indirect tax is one you can kind of evade or avoid by not engaging in certain activity. So if you don't import or export, you're not going to be subject to tariffs and the like. Whereas a direct tax is something where you just can't sort of avoid the tax because it's imposed on you directly. And so because of those sort of limitations for the first 100 years or so, you have most of the taxes being in the form of a few sort of service fees for federal entities, but a lot is being raised through imports and export taxes and the like. And that really starts to change in the late 1800s, where the Congress starts to try to tax more things. And it comes to a head early in the 1900s when Congress tries to impose this income tax, and the Supreme Court says no. And then the 16th Amendment passes, and since then, you have most of the federal revenue being raised by income taxes, and that's really kind of been the fuel, if you will, for the expansion of the federal government. So you just couldn't have the kind of expansive federal government that you have today if you didn't have the 16th Amendment.
Oh, thank you very much for that really thorough overview. And then I'm curious, I'm kind of obsessed with comparative government. So I'm curious how the US tax system kind of broadly compares to that of other countries, specifically on this question of a wealth tax. So I know you mentioned kind of implying other countries have a wealth tax or had expanded efforts to impose like an international wealth tax. So I was curious, do other countries rely a lot on wealth taxes in their system of taxation? Or like otherwise, what are the broad similarities and differences? Does the US tax system stand out in any way?
Yeah, so it does. And I mean, I think wealth taxes I'm not sure that there are a lot of countries that have a long tradition of wealth taxes. I think this is an idea that's gaining sort of currency. And I think part of that is a sense that, like in like if you take like the long view of history, like a lot of the entities that had lots of wealth historically were not sort of normal individuals. They were like the king or they were the church. And so there were kind of restrictions on taxing. The king doesn't tax himself, the queen doesn't tax herself. Churches were often, in church property were often exempt from taxes. So I think the phenomenon of having sort of, private individuals who've amassed a substantial amount of wealth is a relatively new phenomenon, and countries are sort of struggling with this, but it is gaining currency in a lot of places. And most places, you don't have anything analogous to the 16th Amendment that would be a constitutional obstacle to those kind of wealth taxes. So we may see things where other countries adopt these wealth taxes, but there's a reluctance to do it in the United States because of the 16th Amendment. The other big difference, of course, though, is gets down to the idea that although there certainly are other governments that have something like federalism, nobody does federalism quite the way that we do it in the United States. And so one of the things that I think is distinct here is that you have multiple governments that are taxing you. And sometimes, in some circumstances, they're both taxing the same essentially pot of money, if you will. So there's a little bit of a tension then between the federal government's interest and the states. And you do see this with the income taxes. A lot of states had income taxes long before the federal government did, because there wasn't, the equivalent of a prohibition on those kind of taxes in the state constitution. But, there's only so much income that people make. So if the federal government is taxing that income at sort of 30% and the local state is taxing the income at 10%, that sort of only leaves 60%. And it does create some kind of competing interests between the federal government and the state, especially when they're taxing the same thing.
Well, thank you so much. And then I was curious about the aspect of the kind of case between, before the Supreme Court, in that the tax imposition was specifically targeting people who are investing in countries that had foreign ownership. And I was curious about that aspect of it. Is how does our tax code generally extend to non-American companies, and has there ever been like are there mechanisms like that in previous tax policies where uh, people who invest in foreign-owned companies or do business with foreign-owned firms are treated differently in tax policy than American companies?
Sure, that's a great question. And one of the things that's somewhat distinctive about the United States tax policy is they view essentially if you are a US citizen, the federal government wants to tax your worldwide income. So, like, if you have some like a rental property, in a foreign country, like the fact that you earn all that rental income in the foreign country, like that doesn't impress the federal government very much. They still think you're a US taxpayer. And so we're going to tax your income no matter where in the world that you own it. And that, of course, creates the real possibility that you'll be taxed by, let's suppose that you had a house that you rented in Mexico and you make some income on that. That creates the possibility that the Mexican government will tax you for the income because they think, well, you're in Mexico, we're going to tax you in Mexico. And the United States says, well, we're going to tax that income as well. The way that the United States ultimately reconciles this is that in general, they'll still tax all your income no matter where you make it, but they'll give you a tax credit for foreign taxes paid. And so that's the way they kind of reconcile this. But the United States, and not every country does this, but the United States is pretty aggressive at saying, so if you're a citizen of the United States, you're going to pay US income taxes on your income anywhere in the world that you earn it. Now, foreign companies, if they don't come to the United States isn't going to tax them. But if you have, let's say, a company from Mexico that invests in the United States will sort of tax the income that they earn in the United States, but they won't tax the income that they earn outside of the United States. And so all of that's a long windup to saying that what's going on in a case like the one that the Supreme Court has heard is because the government thinks that it does have the ability to tax income kind of wherever it is earned. They don't think the fact that the more is invested in a company abroad is a reason for them not to sort of tax that income. But they still, normally wouldn't tax the income until it's brought back into the United States. And they recognize that, well, there was, this possibility to just kind of defer those taxes indefinitely by keeping the money essentially outside of the United States. And that's precisely what this provision of the tax code was trying to address and basically say, look, whether or not you actually repatriate those funds to the United States, we're going to tax them as if you've brought them back to the United States because we're kind of tired of waiting for you to do that.
I see that. That's really interesting. I didn't realize that that was something that the US does that other countries don't. Well, some other countries don't. And then I guess I only have 40 seconds left, but would you be able to provide a brief overview of how the Supreme Court is expected to rule on this and what sort of the ideological breakdown of opinions are? Because I don't know, it's an interesting case. I could see how it might not split evenly among partisan divides necessarily.
Yeah, I think there were three camps of justices at the argument. There was a camp of justices who were, seemed pretty squarely on the federal government side and seemed to think that the 16th Amendment had pretty clearly opened the power of Congress to pass this kind of tax. Then there was another group of justices that seemed pretty skeptical of this and really seemed to think that you absolutely need a realization event, and the realization event is really bringing the money back to your US-based bank account. And then there seemed like there were a group of justices in the middle, and Justices Kavanaugh and Barrett both asked questions along this lines that seemed to suggest that they could really duck the big questions because they could understand this as a case where the foreign corporation had already realized the income, and it was just a matter of, deciding kind of what counts here, the realization of the income by the foreign corporation or the realization of the foreign corporation's income by the US-based citizen when the money gets repatriated. And they seem to think that Congress could essentially choose between those two taxable events. So I wouldn't be surprised if that middle group of justices, the one I described last, who are looking for this middle way, end up sort of being the justices that control the opinion. And we end up getting an opinion that pretty narrowly upholds this tax, but leaves the question of wealth taxes for another day.
Well, thank you so much. This has been really, really fascinating. And now I'll pass on to Jewel and Jorn.
All right, so we have everybody's favorite topic on the show, taxes. Could you tell us again, though, as simply in this case, is that give us the parameters of the case one more time, just as maybe as juvenile as possible, and what the company is arguing for, who brought it.
Yeah, I mean, I'll try, but it is a little, once you're talking about like foreign income earned abroad and repatriating it, bringing it back into the United States, it's tricky. But like at the simplest level, this couple got hit with a $15,000 tax bill. And their argument in simple terms is like, how can you tax me $15,000? I don't have $15,000 more in my bank account. I don't have $100,000 more in my bank account. I invested in this foreign company, and the foreign company hasn't sort of sent any money my way. They're just kind of getting richer and richer in their corporate treasury abroad. So you can't tax me. And they're relying on the 16th Amendment. And really what they're relying on is the original prohibition on sort of direct taxes in the unamended Constitution. And they're saying, you cannot impose this tax now. You have to wait until I actually have more cash in my wallet. And that doesn't happen in the context of these foreign corporations until they send the money into the United States. So I hope that helps. It is,
does help.
as with these taxes, yes. It is kind of complicated.
It does help, though. I mean, but then when you broke it down to be that simple, it seems far more of a. It seems a bit egregious on the side of the government. I'm a little bit confused to see, is there some way that, so they don't have any more cash from this investment, but they're being taxed on the increase in their net worth, that's not realized. Now, if you took this to its extreme, you literally could have, whether or not they do or not, whether or not they have the cash on hand or not, you could have people who do not have any cash on hand, but with a tax bill that could equal more than the cash that they have or have had access to in the whole year. So I'm a bit I guess I somewhat understand that. No, I really can't understand how it could be ruled in the other's favor. Is there any way that is there some way that this would give way to an evasion strategy where they're able to make purchases and transfer that wealth to themselves without paying taxes on it then?
So I think what, from the government's perspective, maybe like another kind of simple way to think about it is, let's say I buy like a stock for, $10,000. And then at the end of the year, like I picked a great stock. So it's now worth $20,000, right? And so imagine then the government, so I've made $10,000, right? And so imagine the government sends me a tax bill for $1,000. Now I could say, what are you talking about? I can't pay that. I don't have any money in my bank account. Like, it's not like the shares gave me a dividend where I have $1,000 in my bank account. And so, but what the government would say is, yeah, I mean, you don't have any more money in your bank account, but you made $10,000 on the stock. And, so you have to like sell some of it to pay for the taxes. And that's generally not the way taxes work in our country. Like generally, the government waits until you have that extra money in your account, in part because it does seem kind of like harsh to say, like, okay, you made that money and now you got to sell some of it in order to pay, Uncle Sam, so to speak. That seems kind of harsh. But then the other thing that the government would say, and I think it just sort of, and I don't think the issues are really that different here, just because it's a foreign company. What the government would say is, well, but you're going to get richer and richer. That stock is going to be worth like $40,000 the next year and $80,000 the next year, and you're gonna be richer and richer, and yet you won't pay any taxes. And maybe somebody who doesn't have $10,000 lying around to buy stocks, and really is living kind of paycheck to paycheck, like they're going to pay income taxes on the $10,000 they make, and so it's kind of unfair to make somebody who's sort of paying, making less money, has less disposable income, to make them pay their taxes just because they're earning income on a regular basis. And it's not fair to have this person who's better off, who's able to defer their income taxes while they get richer and richer. And like ultimately that's sort of the same logic behind, hey, wait, like, maybe we should tax wealth instead of income, because it's not fair that some of these people are sort of getting richer and richer and they're just not like realizing the income. So that's like, in a nutshell, you can see the arguments on both sides. There's obviously a policy argument there. And then part of the question is, so does our Constitution essentially take sides in that policy debate and say there's certain kind of taxes where you just can't impose them, either because it's too unfair or the framers just didn't want to give Congress the power to impose those kind of taxes?
So this kind of makes me think of another situation that, you really could interweave with this is, suppose my grandmother bought gold when she was a kid. Well, it's almost the same situation. Now that gold is far more valuable than when she purchased it. So now can we look into all of your purchases and see where value is gone? Then we can look at items like even a comic book that just came out. You spent 10 cents for it, but it was a first edition, and now it's worth $20,000.
Right. And I mean, I think those are all good questions. And, one way the government sort of taxes people is, there's also a federal estate tax. So, if your grandmother passes away, heaven forfend, and she gives you that gold, then the government is going to tax you on not what she paid for it, but on its current value. So, she might have my grandfather, I'm old enough that my grandfather had some gold coins from when they were like in circulation before 1933. And the government, said you were supposed to turn them all in, but my grandfather kept a couple of them. So he had, like a $10 coin that was worth $10. But, by the time he died, it was worth, $500. And the government will try to tax you on the difference between those two. Another kind of consideration when you think about this stuff is it's a lot easier to tax people on things like, stocks that are already pretty heavily regulated. It's pretty hard to tax people on comic books and things like that, because the government doesn't have a good sort of system for figuring out how much you paid, what it's worth, and all of the rest. And so part of the logic behind sort of not taxing things until you realize the gain is somewhat more practical, because if you repatriate money into a US bank account, the federal government's going to be able to pick that up. If you sell a stock, there's going to be a transaction that's going to be reported. The government can pick that up. It's just harder when you come with like stocks, and then when you get into other assets that, don't leave the same paper trail. Even if in theory, if you buy a comic book tomorrow and you sell it for a lot of money, like 3 weeks later, in theory, you should pay taxes. but almost impossible for the federal government to figure out how to learn that you did that.
What's so difficult though is also that in a case of an investment, that investment may then go back down. Also, that investment at the time when you would sell those stocks, you will pay taxes on that. So sure, maybe you can try to reconcile it with a tax credit, but in fact, you've then paid you paid taxes at a lot of layers there, and also you may have paid taxes at an investment at its highest, and then you may sell at its lowest. You may pay more taxes than what it's worth by the time that you sell it, because you're the investor taking the risk in any sense. So I think, I mean, in a constitutional sense, it's almost in the language for in looking at our documents, it seems like we would need, our founders did have investments. They understood investments well. This isn't, I think sometimes people think that that like stock is a new thing and that founders wouldn't understand it, but they definitely would. It seems as if we would need particular language for this in an amendment. It seems like we would need particular language because it's a topic they understood, and if they wanted to be able to tax stock, then I believe they would have said it.
So look, I tend to agree with you, and I think that there is this sense in which we talk a lot, like people with investments and things like that, they talk about like sort of paper gains and paper losses, which is like like if I have some statement that says, oh, my investment went up, like that's great, but I don't really have the money in my pocket. And then that same investment, when I have like the paper gains, like if the stock market goes down the next day, all right, I lost a lot of money. Or if people like think about like something like Bitcoin, same thing. Like Bitcoin goes up and then it goes down and then it goes up. And if you taxed it at all those various points, it would be very messy. And I think getting back to your point about the framers, though, like to me, that feels more intrusive. Like for the federal government to come in and basically say, like, yeah, like you haven't like really done anything with that like increase in income, or you bought some gold and the gold's gone up and like you didn't do it, you didn't sell anything with it. Like that seems more intrusive on my liberty than a federal government that says, all right, like you decide whenever you want to sell that gold, like that's totally up to you. But once you do it and you voluntarily enter in a transaction, then we're going to impose some taxes on the transaction. The latter thing, which I think is closer to what the 16th Amendment would allow, and is just less intrusive than the kind of direct tax on just wealth I haven't realized, or especially I think to me the clearest case is like if my house goes up in value just because like people like my neighborhood, like I'm no better off really. Like I still got to pay the bank the mortgage, I still like have to pay upkeep, like so I'm like, it's nice, like in the back of my head it's nice to know that if and when I sold my house I'd get more money, but like I'm probably not going to sell my house for 20 years, so I'm no better off. So it seems pretty crazy that the federal government could just tax me because my house increased in value, as opposed to deciding, okay, you sold your house, you just got a big wad of cash, like we're going to take a little bit of it. Those seem like more intrusive sort of taxes.
Yeah, I think that that idea of realization is really vital to not intrude on us as Americans. But did you have anything before we pass it?
Pass on to
Thank you very much for all of your answers. You really are a great at giving us the information you have. And I'd like to pass to Kathy now for some audience questions.
Well, thank you, Jewel and Jorn, and thank you, Tova. And Paul, thank you for all your great insights so far. Before we go to audience questions, we want to recognize our professors and teachers and students that are here with us today. And we want to give a special shout out to Professor Tokarov, who is from Northwood University in Michigan. And we also want to give a special shout out to Connor and Sharon Cummings, who are watching from Northern Virginia. So thank you to all of our teachers and our students who are watching. And if you are a teacher or student and you want to shout out, just type let us know you're here in the Q&A, and we'll be sure and do that before the end of the show. We also want to thank Las Vegas's KKVV 1060 AM on your radio dial. KKVV airs these programs Monday evenings at 6 p.m. Pacific. So thank you to all of our listeners in Las Vegas. So Paul, one thing I wanted to clarify right before we go to audience questions. So if the Supreme Court decides in favor of more, and if they decide narrowly, that might mean that they're deciding in a very narrow way. In this instance, wealth tax could not be imposed. If they decide more broadly, they might shut the door altogether to a wealth tax. If the Supreme Court does not decide in favor of more and decides as Moore versus the United States decides in favor of, I guess, of the United States or of the current laws that we're operating under, then the Supreme Court, would you say, would be opening the door to more wealth taxes on down the line?
So I think whoever they rule in favor of, whether it's the taxpayer or the government, I think it's going to turn more on whether they rule narrowly or broadly than sort of who they rule for. So they could rule for either side, and if they write it narrowly, then it won't really sort of implicate some of the broader issues. I would say sort of generally that if the taxpayer wins this case, it will probably mean that a wealth tax is of pretty dubious constitutionality. If the government wins, I think it all is going to turn on the narrowness of the decision and what is going to be said. Because I think you could easily see a situation where the government wins 6-3, and some of the more conservative justices, like a Justice Thomas or a Justice Gorsuch, are going to be in the dissent. And then I think everybody will be reading that majority opinion to see, okay, looks like there's kind of 3 votes against any tax like this. So, how hard did the majority work to say, oh, a wealth tax would be different? We don't have to sort of decide kind of the wealth tax issue.
And for our listeners, especially our students who are watching, when you say rule narrowly, can you give an example of that? What does a narrow ruling look like? Does it say this applies to this case only and doesn't have broader implications, or what is a narrow ruling?
Yeah, it sometimes the court can be as explicit as that. The form I think it would take in this case is the narrowest way for them to rule is to say, look, we don't even have to decide whether or not you need a so-called realization event, because the foreign corporation actually did sort of realize this income by the way that they sort of process the transactions abroad. And so, we can defer entirely, like the question of whether you could tax your increase in stock in America, because in this case, there was a realization event abroad, and that's good enough. So I think they could really rule sort of that narrowly, and then they wouldn't be deciding much beyond the fact that this one relatively esoteric provision of the 2007 tax code is constitutional.
Okay. We have some interesting questions about property taxes. Bill Koenigke says, property taxes involve no realization of income, only an assumption of current value. If the SCOTUS strikes down the wealth tax, what effect could their ruling have on property taxes?
So the answer is, it's a great question. It's a great observation, but the answer is really not much, because the property taxes are generally imposed by state and local governments. And they're not, the 16th Amendment doesn't apply to state and local governments. The original constitutional provisions are limited to the federal government. So, and that's another way of kind of illustrating the difference between sort of, we talk about this a lot in terms of the enumerated powers of Congress, and state governments are generally governments that have police powers or plenary powers. They can sort of state and local governments can do anything they want, as long as it doesn't run afoul of like one of the First Amendment or the Second Amendment or one of the affirmative limits. But the federal government, by contrast, can only do those things that they are given the specific enumerated power to do. And that sort of translates into the tax area, where there's nothing certainly in the federal Constitution that says much about there one or two provisions. I don't want to exaggerate, like a state can't impose, New Jersey can't impose an export tax on goods going to New York. So there are limits, but generally speaking, the federal government doesn't say a lot about how state and local governments raise money. So some states have like high property taxes and no sales tax. Other states have low property taxes and high sales tax. Federal Constitution really doesn't say anything to that. So, but I think one of the reasons we don't have a federal property tax is because a federal property tax, the way most of them work, would probably be unconstitutional because it would be a direct tax.
Okay, well, thank you. And then our board member, Jay McConville, is on today, and Jay asks, wasn't a wealth tax tried in France with disastrous consequences, and that wealthy people just removed their property from France and even renounced their citizenship?
No, I mean, I don't know all the details of that, but that sounds right to me. And I think that's part of why, there was this effort to sort of talk among nations to maybe have like a international sort of wealth tax, because I do think, if you taxed wealth of like US taxpayers, you'd have less US taxpayers. And I think we even have real world examples of that. I don't remember all the details, but one of the founders of Facebook or one of these other sort of startups that made a lot of money, one of the founders renounced his US citizenship and moved abroad in order to save taxes. So anytime you have sort of one government taxing something in a different way from others, you can have people sort of vote with their proverbial feet. It doesn't work very well. But and I also think, just going back to what we were talking about, I do think like a wealth tax would be, it would feel more intrusive, I think, because, there's, other than leaving the country, like you can't avoid it. And, with income taxes, you can give more money to charity and you can make less income, or you can earn certain kinds of income that are subject to less taxes. But if they're just going to tax like kind of all your wealth, I mean, I guess you could still give it away to charity, but other than that, there's really no way to avoid those taxes.
Well, thank you. And then Tracy asks if you could tell us a little bit about your time as Solicitor General of the United States. And in this particular case, is the current Solicitor General representing the United States in this case? Just could you tell us a little bit about what I mean, it's just such an honor to have you. We don't often have someone as high ranking as you on our podcast, and just being the former Solicitor General, if you could tell us a little bit about what you did and what maybe the role the current Solicitor General is playing in this case.
Sure, I'd be delighted to. I mean, that's probably a subject for a whole nother podcast, so I'll try to keep it short. But the Solicitor General is the lawyer who represents the executive branch in the Supreme Court. That's the most public job that he or she does. And so, that's the one that sort of captures the public attention. But they also play like a huge behind the scenes role in deciding which cases that the government is going to appeal from like one lower court to another lower court, play a huge role in deciding the position that the United States is going to take in cases where the United States wasn't previously a party. So it's a fabulous job. It's an important job, and the current Solicitor General in this case personally argued the case, and that itself I think shows that this is a pretty big deal. And I would probably say if it weren't for the wealth tax issue lurking in the background, I'd be a little surprised that this is the case that the SG would argue herself. The way it works as a practical matter is that the Supreme Court hears about 10 to 12 cases in a sitting, sometimes less these days, but somewhere between usually about 10 or 12 if they have a reasonably full sitting. And the government probably participates in all but one or two of those cases. And then typically in a sitting, the Solicitor General will argue the case that he or she thinks is most important to the federal government. So the fact that the Solicitor General decided to argue this case herself I think underscores that it's not just an ordinary tax case. And if all that were at issue in this case is this one pretty esoteric provision involving foreign earned income and, in 50% majority companies abroad, I doubt that she would have argued it herself. So I think it really was the fact that there are all these broader issues lurking in the background as to why she argued it.
Well, thank you. And then we have another listener who is written in, who has students with her today. Hope Mucklow wrote in. So we're giving Hope and her homeschooled daughter a shout out. And Hope also wrote, my daughter Elise and I are having a blast with the auction. While we lost 2 bids so far, we're excited to help bid and drive the price up. So thank you, Hope, for that. And we hope that you keep bidding. And we do want to remind all our listeners one more time to go on our website and please bid in our auction. And thank you to Hope and her daughter for listening today. And then we have one last question that we're going to get to here is David Sawyer. And David says, I'm wondering whether a clear decision in favor of the federal government could lead to effective double taxation later, if and when a given U.S. investor, individual, or company in said foreign business sells some or all of its ownership by selling stock and so forth. Thanks.
Yeah, so I think that question is a great one, and it's probably ultimately more of a question of tax policy than constitutional law. Because the way I would think about it, like once you decide that the government can tax something, particularly when there's not an obvious realization event, we generally have a notion that there shouldn't be double taxation, but absent a few situations where, like, you might have an interesting application of the double jeopardy clause or something, but as a general matter, there's no double taxation clause in the Constitution. And so, you could get into, and you see this, like the most obvious example is, the government can tax, my income, and it can tax my capital gains. And then, when I die, if I haven't done effective estate planning, they're going to tax all that same money that I made that they've already taxed when I pass it down to my heirs. And there's no constitutional problem with that. So I think if the government can permissibly tax this kind of income for this foreign company without an obvious U.S. realization event, then I'd like to think that the government would then sort of give the taxpayer credit for the, so then when they ultimately sell the company or they bring the realization event takes place in the United States, I'd like to think that as a matter of tax policy, the federal government would give you a credit for the taxes you already paid. But I don't think anything in the Constitution actually forces them to do that. So in theory, they could tax something like essentially the same income twice.
Well, thank you. And we are right at the top of the hour. So we want to thank you so much for being our guest today. Again, such an honor to have you and a really interesting show. We want to thank our audience for being with us. And we want to remind our audience that next Tuesday, May 28th, we will not have a show, but then we'll be back on June 4th. And we had sent an email out. A lot of our listeners responded. We thank you for all your ideas. Our episodes leading up to July 4th are all going to be with the theme Celebrate America. And we're going to explore what our listeners think what our listeners think the reasons are that we should celebrate America. And so we're real excited to unveil that to you all. And we will be getting the word out on which listeners prevailed and their opinions very soon. So thank you so much for being with us. And we look forward to being back with you in June. Thank you.